Hi, this is Tim Yoder with Fit Small Business, and today I'm going to give you my 10 tips for small businesses managing their cash flow. My first tip is to don't pay your bills until they're due. Now, I know sometimes the easiest thing to do is write a check as soon as you receive a bill, but that's generally not good cash flow management. You'd like to keep as much cash on hand for emergencies that come up or perhaps opportunities that present themselves, like getting a discount for paying a bill faster than normal. So don't pay your bills until due. The easiest way to track your unpaid bills is to use an accounts payable software or an accounting software like QuickBooks Online that has a bill payment management feature. So enter your bills as they're received. Your software will help remind you to make sure you pay them on time. So you want to pay them on time, but don't pay them early. My second tip is to invoice your customers quickly once work is complete. So not only will you receive your cash faster by sending them the invoice faster, they'll pay the invoice faster. So when they receive the invoice and the work or the product they just received is still on their mind, they're much more likely to pay it quickly. If it's been a month since the work's complete, they're going to receive that invoice and wonder if they'd already paid it. They're going to have to do some research. They're going to set it on their desk and it's going to get buried. So invoice your customers very quickly. That will really speed up your cash collections. Reconcile your bank account regularly. So not only does this catch errors, it's a really important step to make sure that you don't overdraw on your checking account, because the errors or the omissions in your accounting records, so say withdrawals that are on your bank statement that are not in your accounting records, those could very easily cause you to overdraft in your checking account, which of course costs bank fees and perhaps even your relationship with vendors. Utilize a line of credit. So there are times when you want to use cash that it may be worth borrowing on a line of credit. So perhaps you can use a line of credit to avoid late payment fees. That might be worth it. You could also use a line of credit to take advantage of early payment discounts. So perhaps if your vendor gives you a 2% 10 net 30, that means that if you pay within 10 days, you get a 2% discount. Well, that's really great. You're only paying 20 days early, 10 days instead of 30. You're paying 20 days early and getting a 2% savings. That is a huge annualized rate of return on that. So that would be very worth utilizing a line of credit. Now, obviously, you don't want to use it more than you have to because they do charge you interest, but there are certainly opportunities where it makes sense to pay a little interest in order to have some extra cash. If you're not that familiar with bill payment terms, I will throw a link in the description below to an article we have that describes common invoice terms and the early payment discounts, etc. So I'll throw that into the description below. I encourage you to accept electronic payments or checks rather than just accepting cash. So first off, the presence of cash is obviously opens up the possibility of theft, so we'd prefer not to have cash. Checks are better. At least they're a little harder to steal, but they still take time to process. Ideally, we'd like all of our customers paying with credit cards. Those get into our checking account much faster. Now, obviously, there are some fees associated with credit cards, but make sure when you're deciding whether those fees are worth it, you're taking into account how quickly the money gets into your checking account and is then available for things like early payment discounts without having to borrow on a line of credit. And also remember that by paying those credit card fees, you're not having to worry about theft of checks or money. Deposit all your cash received daily. So wouldn't it be a shame if you overdraft your checking account while you have a pile of undeposited checks sitting in your desk? Obviously, we don't want that to happen. So deposit all of your cash and checks received daily. Make sure you deposit all of the cash received. Don't take money out. Don't take cash out to use before it's being deposited. Owners, I know it's very tempting to just stick your hand in the cash register and take out whatever you need for lunch, but you really shouldn't do that, because once you do that, you lose all control of your cash flow, right? You need the cash deposited in the bank to equal the cash received by your business that day. That way you know no cash has gone missing. Once you start taking out a little cash, things don't balance, and it's very hard to tell how much cash was taken out. So make sure the cash gets deposited before it gets spent, so that we have a proper paper trail. If you have excess cash, we've talked about what to do if you're short of cash. That would be a line of credit. If you have excess cash, consider something like a money market. Checking accounts typically pay very little interest, if any. Savings account tends to be a little bit better, but money market accounts tend to be better yet than savings accounts. Money market accounts are not FDIC insured, so make sure you understand that. However, they are very low risk. Their investment objective is to maintain a market value of $1 per share. It's extremely rare for a money market account to dip down below $1 or above $1. It stays right at $1. Pays you interest. It acts like a bank account essentially. However, it is not FDIC insured. Establish a petty cash fund. So don't waste a lot of time writing checks for every little expense. Make sure you have a petty cash fund. So little expenses like, say, a pizza for the office at lunchtime can just be reimbursed out of petty cash instead of having a separate check written. So I will throw a link below to an article we have on how to manage a petty cash fund so that you can see exactly how to do that. If you're interested, it saves a lot of headache with smaller expenses. You need to segregate your cash handling and recording duties. So you need to have one person that's holding the cash, their cash custodian, and that can't be the same person that's recording the transaction, which is your bookkeeper. So you need to have a custodian of the cash and checks, and you need to have a bookkeeper, and those need to be separate people. And finally, determine your cash conversion cycle. And so this is really something to help evaluate your cash management to see if you're doing a good job or not. Essentially, this cycle measures the number of days it takes from the time you order inventory, actually until you purchase inventory, until you actually then receive the cash back from the customers to complete the cash cycle. So it's when do you pay for inventory, then you receive the inventory, then you sell the inventory, then you collect the receivable. So how long does that take? That's your cash conversion cycle, and obviously we would like that to be as short as possible. So as you implement new cash management techniques, issuing your invoices within 48 hours, following up on delinquent invoices very quickly. As you do all these things, as you introduce new policies, track that cash conversion cycle to see the improvements that you're making. Now, I'm not going to go into the detail of how to calculate this right here. I will include a link to our cash management tips article that goes along with this video. And in that article, we do have a calculator as well as detail as to how to calculate this cash conversion cycle. So those are my 10 tips for small businesses in managing your cash flows. I hope that was helpful. My name was Tim Yoder, and I hope to see you again soon.